In our previous presentation, we addressed the question of how does the value of the firm change if it takes on a particular dollar amount of debt. And we had the example of CVS perhaps taking on $20 billion of debt instead of taking on no amount of debt. And what we said is that the value of the levered firm, that is the value of the firm with debt, is equal to the value of the unlevered firm plus the present value of the tax deduction on interest expense. And in the situation in which the business has a constant dollar amount of debt, like $20 billion, the present value of that tax deduction is equal to the amount of debt times the corporate tax rate. So we had our equation that says VL equals VU plus tax rate times D for debt. Well, we only ended up with that equation that the value of the levered firm is the value of the unlevered firm plus tax rate times debt, because we assume that that amount of debt remains constant, and so the interest expense remains constant, the expected tax break on interest remains constant, and then we went on to assume that a fair discount rate for valuing that tax deduction cash flow stream is equal to the cost of debt itself. All that had to happen, all those assumptions had to be made for that equation to hold. We then went on to say that if you have all of those assumptions, then we have an equation for the cost of equity, which says the cost of equity is equal to the expected return on assets times 1 plus the debt to equity ratio times 1 minus the corporate tax rate minus the cost of debt times the debt to equity ratio times 1 minus the corporate tax rate. So we have these equations with corporate taxes, the cost of equity is equal to the expected return on assets plus expected return on assets minus cost of debt times debt equity ratio times 1 minus the corporate tax rate. But it's not normal to assume that a company is going to have the same dollar amount of debt year after year. That's not a normal assumption. When we did our weighted average cost of capital, we didn't make that assumption as a normal case. We said typically we think of percentage leverage. So as an illustration, I said that a utility typically has about 50% leverage, debt, so debt plus equity. A early stage startup technology company might have very low leverage or even no leverage. Domino's, for example, has like a modest degree of leverage. The percentage of leverage that a company typically takes on is a function of whether its assets are going to maintain value regardless of who owns those assets. So what we really want to do is come up with equations which line up to the assumptions that we typically make. And the typical assumption we make is that the percentage of leverage is going to be maintained over time. So let's redo our equations and redo our example with CVS under the assumption that the percentage of leverage is going to be maintained at some continuous estimate over time. So here's what we're going to do. The concept is, for a growing firm, there's going to be more debt over time because firm value is growing over time. So if you take CVS and say, for example, CVS I expect to maintain 30% debt, 70% equity over time, if CVS does really well, so the value of the enterprise goes up over some particular time frame, and you maintain 30% leverage, that means the amount of debt is going to go up. And if CVS does poorly, there's a big shock, there's a downturn in the consumer goods market, there's a downturn in the demand for pharmaceutical products, then something else is going to happen. So the implication is that if things go well for CVS, enterprise value goes up, the amount of debt in dollar terms goes up because it's going to be held as a constant percentage of enterprise value. And with more debt, there are more tax breaks on debt because there's more tax deductions on interest. If CVS does poorly, enterprise value goes down. The amount of debt in dollar terms goes down because it's being held at a constant percentage of enterprise value. there are less interest tax deductions, and therefore the present value of those tax deductions goes down. So the implication is for our borrowing project, remember I said you have to think about this as a borrowing project. The implication is that if you maintain a constant percentage of debt over time, the discount rate associated with those tax breaks, that is the cash flows from the borrowing projects, is now different. It's a riskier discount rate because the cash flows and therefore the value of the borrowing project are now moving up and down with the value of the whole business. The riskier the whole business, the riskier those cash flows. When we had our constant dollar amount of debt, the tax deduction associated with that interest expense wasn't really shifting up and down each year as the firm's the firm's prospects went up and down. But if we're going to maintain a constant percentage of debt, the value of the present value of these tax breaks is going up and down with firm value. That means that the discount rate should somehow reflect the risk of the underlying assets. And the implication of this argument, which is not a mathematical proof, it's an argument, is that a reasonable proxy for the discount rate for the tax benefits, if you're going to assume that the percentage of debt remains constant, is the expected return on assets itself. Now, and with a bit of algebra, which I don't go through in this presentation, with a bit of algebra, the implication is that our cost of equity equation is no longer going to have 1 minus tax rate in the equation. And that's why we end up with this slide here. If the percentage of debt is going to remain constant, you have the equation on the right. The cost of equity is the expected return on assets plus expected return on assets minus the cost of debt times the debt to equity ratio. 1 minus tax rate has disappeared. But it hasn't disappeared because we're ignoring corporate taxes. It disappears because it is a mathematical result of assuming that the discount rate for the tax deduction on interest is equal to the expected return on assets itself. Once you make that assumption, you end up with the equation for the cost of equity on the right-hand side. So in aggregate, when you're thinking about how leverage affects the cost of equity, in our perfect capital market, where we had no taxes, you've got this equation in the top right-hand corner. In our market with corporate taxes, in which the percentage of debt is assumed to remain constant over time, you have the same equation on the right-hand side. Cost of equity is expected return on assets plus expected return on assets minus cost of debt times the debt to equity ratio. And finally, if you make the assumption that the dollars amount of debt is going to remain constant, like $1 billion or $20 billion, you've got a very similar equation, but 1 minus tax rate appears in the bottom. So it's got nothing to do with whether corporate taxes exist or not. Both these equations on the bottom right exist in a world with corporate taxes. Whether the 1 minus tax rate factor appears or doesn't appear depends upon whether you're going to assume a constant dollar amount of debt over time, in which case 1 minus tax rate does appear, or whether you want to assume a constant percentage of debt remains constant over time, in which case 1 minus tax rate does not appear. So let's apply this to our example. It's only going to make sense if you work through it with an example. At 10% debt, what's the cost of equity? So this is a constant percentage debt assumption now, 10% instead of $20 billion. According to our equation, the cost of equity should be 10.56%. That was a 10% expected return on assets plus a 10% expected return on assets minus a 5% cost of debt times a 10 versus 90 debt to equity ratio. And that gives us a cost of equity of 10.56%. What would be our weighted average cost of capital? 10.5% cost of equity times 90% equity to debt plus equity, plus 5% cost of debt times 1 minus the corporate tax rate times a 10% leverage, weighted average cost of capital of 9.9%. If you apply that weighted average cost of capital to the free cash flows for CVS, instead of our baseline 10% figure, you end up with $116 billion of enterprise value. How much debt is there? 10% of enterprise value, or $11.6 billion. And how much equity value is there? Enterprise value minus debt, that's $104.5 billion. How could we compute the tax benefits of debt finance? Well, under this assumption, it's not anymore tax rate times the amount of debt. That's gone now. That equation only held if we had a constant dollar amount of debt in the capital structure. In this world, all we can do is say, what's the value of the firm without debt? That was $114.1 billion. What's the value of this alternative firm where there is debt, and that percentage of debt relative to debt plus equity is maintained at 10%? The value of the firm with debt is $116 billion. The difference must be the present value of the tax benefits, which is $2 billion. Why did the value of the tax benefits come down? Why did it come down from the $4.2 billion we had earlier? Because 10% debt gave us just $11.6 billion. That was less debt to start with than the $20 billion of debt. Now, even though as CVS grows, there's going to be more debt over time, the fact that we're starting with less debt compared to our $20 billion assumption means that in aggregate there's less debt and therefore less tax breaks. There is a third, more complicated scenario. The two scenarios or assumptions we've made with regard to debt finance is either the firm is going to borrow a bunch of money and just leave it there as that dollar amount of debt, or the firm is going to borrow a bunch of money and maintain a constant percentage debt to debt plus equity ratio. A third, more complex scenario is where neither the percentage of debt nor the dollars of debt are constant. Now, this is not for our class. This is to make you aware that in reality, the real world assumption you might have to confront is where a company says, in year 0, we're going to have $20 billion of debt. In year 1, we're going to have $25 billion of debt. In year 6, we're going to pay that down and end up with $15 billion of debt. So the amount of debt could be fluctuating according to some time series. For example, in a leveraged buyout, the acquiring company, the acquiring shareholders might say, we want to start with lots of debt, and then we're going to gradually pay that down over time and then try to sell this asset to someone else who has a lower degree of risk tolerance. In that framework, you have to model how much debt there is over time, model the interest expense over time each year in your spreadsheet, model the tax deduction for interest expense each year in your spreadsheet, and then compute the present value of that time series of interest tax deductions. Now, we're not doing that. We're just going to have two alternative cases. One where there's a constant dollar amount of debt, and two where there's a constant percentage of debt. But you should be aware that these alternative and more advanced situations exist because you might have to confront them in reality, and we do cover them in other courses. So to summarise, if we had one market imperfection, which is just having corporate taxes in our analysis, and everything else is a perfect capital market, here is our situation. With constant dollars amounts of debt, like $20 billion, we have the value of the firm with debt is equal to the value of the firm without debt plus the present value of tax benefits. That was the same if you had a constant percentage of debt. That's our general equation that always holds. But then how do you come up with that general equation? How do you value the entire firm? For computational convenience, if you have a constant dollar amount of debt, you should say, what's the value of the firm without debt? So use the same cash flow definition that we've always used and use the expected return on assets as the discount rate. And that's also called the unlevered cost of equity as the discount rate. And then separately estimate the value of those interest tax deductions as the tax rate times the amount of debt. In the alternative situation in which you've got a constant percentage of debt, you just estimate the value of the whole firm as the present value of the cash flows discounted at the weighted average cost of capital, which we did in our weighted average cost of capital module. Nothing here has changed. And the weighted average cost of capital is defined as cost of equity times the proportion of equity finance plus the cost of debt times 1 minus the tax rate times the proportion of debt finance. So again, if your dollars of debt are going to stay constant, use the equations on the left-hand side for valuation. If your percentage of debt is going to remain constant, use the equations on the right to estimate the present value of the cash flows. To estimate the cost of equity and to see how the cost of equity changes as you change leverage, if you've got constant dollars of debt, you've got cost of equity is the cost of equity without debt, also called the expected return on assets, plus the cost of equity without debt minus the cost of debt times debt to equity times 1 minus tax rate. If you've got a constant percentage of debt in the business, like 30% to 70%, that percentage is going to be maintained every year forever. The 1 minus tax rate disappears from the equation. Now, we're not ignoring corporate taxes. Corporate taxes are still part of the analysis. It's just that algebraically they drop out of the equation once you assume that a fair discount rate for the borrowing project is equal to the expected return on assets itself. And it's a mathematical result from that assumption. Finally, let's comment about the weighted average cost of capital. If you have a constant dollar amount of debt, like $20 billion, the weighted average cost of capital won't be constant over time because the debt's going to stay constant in dollar terms, but the value of the firm each year is going to be different. And therefore, the weighted average cost of capital will be different every year because you've got a different proportion of debt versus equity finance in the business. But with a constant percentage of debt to finance the business, the weighted average cost of capital will be constant over time. And that's a fundamental difference. Now, all of this is fairly complicated, right? There's lots of equations and algebra and things to remember. In our applications, in our problem sets, in which we have a vast number of problems, we work through many of these computations to illustrate the points. I've worked through many computations here with CVS, but you must work through over and over again the applications of this analysis for it to stick. It won't stick if you attempt to simply memorize these equations. It's a bit like saying if you wanted to take a driving test, you couldn't sit through 4 hours of lectures while someone taught you how to drive a car and then someone hands you the keys. You have to work these equations in the problems that we have already laid out in order to understand and remember those equations. Now, even though you're going to have access to these equations in practice, it's the understanding which is important because people consistently misapply these equations and they unravel all of their good work in valuation by making mathematical errors. The last thing to note is that these equations which I've been presenting, I haven't presented with any algebraic proofs. Specifically, these equations for the cost of equity, I didn't prove those equations to you in the presentation. Why not? Because for many people, it's just too much. So if I try to prove those equations in the classroom, their eyes glaze over, there's too much algebra working through the steps, it's a really uncomfortable and boring experience, they don't want to hear it. There's another group of students that wants to see the proof. And they're disappointed when I just present these equations. They want to say, but why do you get that result? How do you get there? So in the appendix to this presentation, I have written down the proof. Now, I didn't invent this proof. Other people have written down the same proof. But the first proof says the cost of equity, assuming constant dollars of debt, ends up being the cost of equity equals the expected return on assets plus expected return on assets minus cost of debt times 1 minus tax rate times debt to equity. And if you work through those steps, you'll end up with that algebraic result. The second equation says if you assume a constant percentage of debt, you work through a series of algebraic steps, you end up with the equation that says the cost of equity is the expected return on assets plus expected return on assets minus the cost of debt times the debt to equity ratio. Now, I'm not going to expect you to repeat that mathematical proof. Hence my big red letters, not for assessment, not for assessment. But I'm trying to point out that these equations didn't just come out from thin air. Right? They are a mathematical derivation that relies upon crucial assumptions. If we assume constant dollars amounts of debt, the crucial assumption here is that the tax benefits project had a discount rate equal to the cost of debt itself. And that equation flowed through everywhere to end up with the result for the cost of equity that we saw. Under the constant percentage of debt assumption, the crucial assumption flowing through to the cost of equity is that the tax benefits project has a fair discount rate equal to the expected return on assets. And if you make that assumption, algebraically it flows through to the equation that you see at the bottom of the slide. That's what makes the difference. Finally, for you prospective investment bankers out there, going back to our equation for equity beta, if you assume this, equity beta equals asset beta times 1 plus debt to equity times 1 minus corporate tax rate, that equation corresponds to an equation that says the cost of equity is equal to the expected return on assets times 1 plus debt to equity times 1 minus tax rate. That equation is based upon the assumption that, number one, the cost of debt is equal to the risk-free rate, and number two, that the dollars of debt remain constant. I guarantee you that in almost all of your valuation models, you're going to assume that the cost of debt is above the risk-free rate, and you're also going to assume that we're going to hold a constant weighted average cost of capital, and within your weighted average cost of capital, you're going to have the equity on debt plus equity and debt on debt plus equity remain constant in percentage terms over time. Both those assumptions that you're going to make in your modelling are inconsistent with these two equations. So stop using them. If you're going to make those two assumptions in the box there, use the equation on the bottom left-hand corner here that says the cost of equity is equal to expected return on assets plus expected return on assets minus the cost of debt times debt to equity. And if you want the beta version of that, it's that equity beta is equal to asset beta plus asset beta minus debt beta times the debt to equity ratio. And where's the debt beta come from? Cost of debt minus the risk-free rate divided by the market risk premium. So in summary, we've now introduced one market imperfection. We started with a perfect capital market, and we said that in a perfect capital market, valuation and weighted average cost of capital is not affected by capital structure. We introduced one market imperfection. We said that with this one market imperfection of corporate taxes, the value of the firm is maximised by taking on all debt finance except for issuing one share, so capital structure makes sense. So you take on all debt, and you end up with the value of the levered firm is the value of the unlevered firm plus the present value of the tax deduction for interest. We had two alternative versions of leverage. We said you can have a constant dollar amount of debt or a constant percentage of debt, and they have different implications for the cost of equity. But we still end up with the case that you maximise value by just taking on all of this debt. That doesn't happen in reality. So in upcoming classes, we can consider why not. And why not is that when you take on debt, you increase the costs of financial distress. That is some loss in firm value associated with being in a distressed state. And there are also conflicts of interest between shareholders, lenders and executives. And that all goes into the mix to determine an optimal capital structure. I look forward to our discussion.